Hello, everyone. Thank you for joining us for the 567 workshop. My name is John Roney, and I'll be your presenter for the Savvy Tax Planning presentation. Before we get started, I wanted to ask you a question. What is keeping you up at night? What makes you sign up for this webinar? I mean, most of you probably don't love the subject of taxes as much as I do, and yet you're here. I bet there's a specific reason for it. What's currently your greatest concern regarding your retirement assets and plans? Is it the recent inflation and how it might impact your retirement? Or maybe it's losing money in the stock market. It might be paying too much in taxes or being unprepared for the unexpected healthcare issues. Put your answers in the Q&A at the bottom right-hand corner of the workshop. All of the questions are private and only I can see them. I'll give you a second to answer. Thank you to those who are answering. I see there's a lot of concern about running out of money in retirement. I can also see being unprepared for the unexpected healthcare issues. This is great stuff. Thank you. It's much easier to know what matters to you. That way, in the next 45 minutes or so, I'll try to get to all of your questions and comments and address any concerns you may have. Before we dive into our presentation, let's warm up with a little tax brain teaser, maybe a little tongue teaser too, about Bill. Sounds like fun, right? So after working hard all his adult life, Bill 65 has finally retired, and he's going to go to more concerts than ever before. Bill has $41,825 in his taxable income, which includes $25,000 of Social Security benefits this year. As you can see, Bill's $41,825 of taxable income puts him directly in the 22% tax bracket. It's more than the $41,775 and less than the $89,076. Towards the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin. How much do you think he's taxed on that extra $1,000? The logical answer is that for every dollar of IRA money he pulls out, he pays 22% in federal income taxes. Therefore, if he took out $1,000, he should owe $220 of federal income tax. That's a 22% tax rate. Simple enough, right? Wrong. He owes $407 in tax. That's a 40.7 federal tax rate on that income. Thanks to the madness that is our tax code and the unique formula that determines how Social Security benefits are taxed, the real answer is that Bill owes $407 on that extra income. So welcome to our presentation, how tax planning changes through the 4 stages of retirement. Like I said before, my name is John Roney. I am a financial planner with Roney Insurance Solutions. I specialize in retirement and estate planning. I thank you for coming out to learn more about taxes and retirement. And I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, why is a financial professional giving a presentation about tax planning? Well, from time to time, I present workshops and classes on various financial education topics, such as Social Security, retirement planning, IRA planning, long-term care planning, and college planning, and many more. My goal is to always inform and educate my audience so you can understand how critical financial planning topics affect you and your family. I do this presentation because I've seen people make mistakes and pay more taxes in retirement than is necessary. And when that happens, it makes my job harder. People have less income in retirement, and we have to find ways to make their portfolios last. Taxes can seem complex and jargon-filled, even though the underlying concepts are fairly straightforward. So let me take a second and explain how our workshop will unfold. This presentation is organized into 4 keys. Each key builds on the previous one to form a solution to our presentation's problem, as you'll see. Second are the questions. I know you're going to have a lot of questions as we go along, and hopefully we'll answer all of them or some of them. But if we run too long in our workshop, what I've done in the past is I will take all of your questions and I will answer them and email those out to everyone who attended this workshop. The third part is we're going to have 3 poll questions. One you've already answered, and we'll have 2 more during this workshop. And the last, which I think is a really great value for you for attending this workshop, is the Retirement Money Guide Complimentary Private Consultation. Now, this brings into my experience and technology. It allows you to get a secured login, upload all your financials, and we can do a complete retirement look and see how you're doing, whether you're in pre-retirement or you're in retirement currently. That's the one best thing about attending this workshop is you'll get that for free for 1 year. Now that you can see what we'll review tonight on our agenda, there's another important thing I need to point out to you. Everyone's tax situation is different, and you should always consult a qualified tax advisor to discuss your specific tax situation, especially about these topics: traditional IRAs, Roth IRAs, state taxes. Even though I'm a financial planner, I do not provide tax advice. What I do help people understand is how the tax code and other rules can impact their financial planning and investments. And then we develop a plan to take into account many of the odd things that people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game and spending assets in retirement is much different than the accumulation game you're probably in when you're in saving for retirement. Chances are you've been in the accumulation phase of your life for several decades, and you've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children are grown, and that means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest tax deductions. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you stopped working, you may no longer have the ability to stash income in a 401k or similar plan to manage your annual tax bill. At some point, you'll start taking Social Security, and sooner or later, you'll reach 72, and you'll have to start taking the required minimum distributions from your retirement account. The list of changes go on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. Now, at this point, you may be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is, our first key. You must know what your after-tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start taking required minimum distributions after you turn 72. Obviously, the higher the tax rate in retirement, the less your account is actually worth. Here's an example. This chart shows the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. As you can see, the lower the tax rate, the more you keep. Simple in theory, but difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees. So don't worry if you already started your retirement. Tax planning is important throughout your retirement. Now you may be thinking, okay, my accounts may not be worth as much as I thought, but I already have a steady flow of benefits from Social Security to supplement my income, and I have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is key number 2. Social Security and Medicare have their own tax traps that you need to plan for as well. Let's take a look at Social Security and taxes. Let's go back to Bill from our tax brain teaser. We want to understand why he paid such a high tax rate on the extra money he took from the IRA to go on that concert trip. Remember, Bill has $38,000 of IRA income, part of his adjusted gross income of the $56,525, and he has $25,000 of Social Security benefits. That puts him squarely in that 22% tax bracket, and he takes standard deductions. Yet when he took that extra $1,000 IRA distribution, he got hit with nearly a 41% marginal tax rate, the $407 on that $1,000. Let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from his IRA. You see this in the after concert trip column that has $39,000 of IRA income. So we see here that by adding the additional $1,000 of actual income, it has increased both his AGI and its taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed $1.85. That doesn't make sense. Here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income tax is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income, after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% tax rate for every $1 of additional IRA income he actually receives. If you do the math on it, it comes out to 40.7 real tax rate on the additional $1,000 of income. And that's the so-called Social Security Tax Torpedo. It can impact single filers and married couples with even fairly modest incomes during any stage of their retirement. It is the reason planning taxes and retirement is so important. Now, let's take a look at Medicare and taxes. There's a lot to swallow here, so pay close attention. Let's take a look at how Medicare and something it's called IRMAA can impact couples in the go-go years and beyond. First, what is IRMAA? It stands for Income-Related Monthly Adjusted Amount. The emphasis is on income because it is a monthly tiered surcharge, again, kind of a tax, that is tacked on to people's Medicare Part B and D. But it only happens if your income is over $91,000 for singles and $182,000 for married couples. Let's take a look at what that means in action. Meet George and Martha. They are high-earning married couple, and both are in Medicare Part B and D participants. IRMAA surcharges affects income for 2 years prior, and this couple was on track for $283,500 of modified adjusted gross income, or MAGI, in 2020. But of course, on December 1st, 2020, George decided to sell a stock that he bought for $10,000 on July 1st, 2007. He sold the stock for $11,000. That's resulting in a $1,000 gain and it was taxed at 50% of long-term care capital gains rate, plus an additional 3.8 net investment income surtax for the total federal tax bill of 18.8%. Now, that 3.8% net investment income surtax is another tax that comes into play when your MAGI exceeds $200,000 for singles or $250,000 for married couples. So George and Martha owe $188 of tax on that gain from their sell their stock, right? That 18.8% of $1,000. Or do they? Remember, the definition of tax is any cost that increases your income as your income increases. So then George and Martha will owe more tax on the 188 because the gain from the sale of the stock pushed them over the Medicare IRMAA Cliff into the higher paying Medicare premiums. Let's take a look. Look at the Part B IRMAA chart. That chart, the $1,000 gain pushed the AGI into the next premium tier that starts with $284,001. So now, instead of owing $340.20 for each of their Medicare Part B premiums, George and Martha now owe $442.30 per month, an extra $102.10 per month, times 2 equals $204.20, for an additional total of income-related monthly adjusted Medicare Part B premiums of nearly $2,450.40. But it's not over because there's Medicare Part D IRMAA charges also are impacted. George and Martha will each owe about $19 per month on their drug plans, an extra $466 for the couple over the course of the year. Now, there was a lot of numbers there, so we're going to get to it and we'll review it. But adding all the IRMAA surcharges together for the year, George and Martha will each owe about an extra $121 a month, or about $2,915 a year. So let's review. Now combine that amount with the $188 of actual federal income tax they would owe on the stock sale and the total owed on the $1,000 of gain to $3,104. That is a tax rate of 310%. Let me repeat. That is a tax rate of 310%. Let's do a quick review. The stock sale tax was $188. That's 15% long-term capital gains, and that 3.8% for the net investment income for the high earners for an 18.8% tax rate. The extra income from the stock sale triggers new IRMAA tiers. The total IRMAA surcharges amount for the year to $2,916 for George and Martha. So the $1,000 of extra income triggers $3,104 of extra tax. That's a 310% real tax rate. You see, being pushed into the higher Medicare Part B and D premium range is worse than being pushed higher into a higher tax bracket. Because if you go into a regular tax bracket by even a single dollar, only that last dollar is taxed at the highest rate. But if you go over Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMAA Cliff. Now, keep in mind, your IRMAA payments are determined on how much money you made the previous year, but rather the MAGI for the 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann, both 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offered health care benefits. Unfortunately, they did not know that they had to enroll in the Medicare Part B as soon as Ann retired. Even though Ann's employer offered retirees health care insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they were unable to begin coverage until the next year. In a worst case scenario, this might have resulted in a gap of coverage for Jim and Ann if they had a major medical need. But even in the best case scenario, because Jim and Ann missed the deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B based premium penalty for life. That's a penalty for life. You can see how much that translates to real dollars. They owe $408 in extra taxes in 2022. And historically, we can estimate that premiums will be much higher. So that 10% penalty will grow and grow. Over the course of the lifetime, that could translate into a $10,000 mistake for the couple. But for simplicity's sake, we'll assume that Ann's healthcare insurance covers prescription drugs so that we don't have to sign up for Part D. Just know there's a penalty for that too. We've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some of those who've seen this presentation, you'll be asking yourself, wow, are there other tax traps we'll face in retirement? Well, the rest of what we'll cover isn't like what we've seen in the Social Security Tax Torpedo or the Medicare IRMAA Cliff. The public generally isn't aware of those tax squeezes. What we're going to see is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when to use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. It's one of the most important things you can do. You can't be haphazard about tapping your tax-deferred savings. Timing is everything, and you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. Now let's look at our polling question number 2. Who believes taxes are going up in the future? I'll give you a few seconds to answer. As most of you probably guessed, everybody believes that taxes are going up in the future. Let's take a look at first by addressing a question I hear when doing retirement planning. Which accounts to spend first? One way to help manage your income both before and during retirement is to utilize a Roth IRA conversion. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement accounts like a 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year, and you'll be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have added $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it is recommended that prior to making any conversions, you consult your tax professional. A conversion doesn't have to be all or nothing, though. One helpful conversion approach is it's called filling up your brackets. Often you may find yourself in the middle of one of your tax brackets with room to add more income without pushing yourself in that higher bracket. For example, in 2022, the 22% tax bracket for married couples filing a joint return goes from $83,550 to about $178,000. If you file a joint return of taxable income of $100,000, that means you have an additional $78,000 of income without going into the next tax bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, the approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help you reduce the average tax you'll pay on your converted money and also spreads the tax bill over a longer period. Some tactics that you'll see in using managing income around tax brackets might include withdrawing tax-free money from life insurance policies to keep your income tax low, selling high appreciated stock or low or capital gains or no capital gains, taking distributions from IRAs or 401ks to take advantage of lower tax rates. And as you've seen, you can also consider partial Roth conversions to fill up your lower tax brackets. There are also pre-retirement tax strategies to consider, but they don't apply to all people. The first has to do with what we call a health savings account. This would only apply to people who are covered by a high deductible health plan or HDHP. The second has to do with a small business owner. Those who want to be extra tax savvy and saving for retirement can fund a company pension plan, which for certain high earning businesses owners can increase the ability to claim qualified business income deductions. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favor benefits throughout retirement. As you can see in the bottom left hand of your corner, I really recommend the Retirement Money Guide. As you've seen in part of our workshop, there's a lot of tax traps out there. And one of the most important things for you to do is to see where you are today in your retirement so that you don't make those mistakes in the future. So I suggest you click on that. It'll take you to an appointment screen, which you can simply close out and return back to the workshop. I'll give you a second to do that now. Okay, let's move on. We've seen throughout our presentation the critical importance of managing our tax-deferred accounts, because once you're over 72, you're forced to take required minimum distributions or RMDs, and that can be troublesome for your tax bill. But many people make charitable donations, supporting their favorite nonprofit or annual gifts. So let's look at how RMDs and charitable giving may work for you with some planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for a married couple filing joint return in 2022 is $25,900, but Albert and Shirley are over 65, so they each get an additional standard deduction, bringing their total standard deduction for 2022 to roughly $28,700. That means they'll receive no tax benefit for any itemized deductions unless their total exceeds $28,700 mark. So if Albert and Shirley have $15,000 of existing itemized deductions, say from the state and local taxes and deductible medical expenses and mortgage interest, that happens tax-wise if they donate what happens tax-wise if they donate $5,000 to charity? They get no federal income tax benefit from making that charitable contribution because it does not exceed the $28,700 standard deduction. That's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. And we'll show you how they can do it correctly in the next couple of slides. Now, if you're over 70 and a half and you have an IRA or an inherited IRA, there is another way to give to charity that's simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how it works so you can see what a QCD can be so powerful. First, some rules. If you're 70 and a half and older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married, both of you are 70 and a half and older, and both of you have an IRA, you can each make a $100,000 qualified charitable contribution from your own IRA. Second, any charitable distributions you make count towards satisfying your required minimum distributions for the year. However, when you make the distribution from the IRA, it must go directly from your IRA to the qualified charity. Or you can receive a check from the IRA custodian made payable to the charity. Third, there is an odd part. Even though you gave to charity, you get no income tax deduction. So why would I suggest a strategy that you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from your IRA is never counted as income when you compute your taxes. Let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits it into his bank. He's done with his RMDs for the year. Now, being charitable people, they donate $5,000 to charity. The end result is the charity gets $5,000. Everybody understands that, right? But let's look more closely. By the virtue of giving to charity this way, Albert and Shirley, the $5,000 charitable contribution will cost them $6,200. Why? Because the $5,000 RMD that went into the Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple's in the 24% tax bracket, and 24% times 5,000 equals $1,200. So the $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means that the total cost of their charitable gift is $5,000 plus the $1,200, or $6,200. Remember, the gift didn't impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Let's look at the next slide. Now let's see what happens if Albert and Shirley use the QCD to give $5,000 charity. Instead of requesting $5,000 distribution from his IRA to go in his bank account, Albert would simply have the IRA custodian transfer the $5,000 RMD directly to his IRA to the charity. That satisfies Albert's yearly RMD because he is over 72. Now, the charity is in the same position as before. They received the $5,000 donation. That's a good day. And Albert and Shirley, however, are in a better position. They still give $5,000 to charity, even though they received no tax deduction for making the contribution. Their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000, a $1,200 savings. He can make that trip with Bill to Austin and go to the Willie Nelson concert. Over the previous example, simply by knowing how to use the tax rules to their advantage, and they did it all without getting a deduction. But we all know that charity starts at home. So it's natural to question. The question to ask is, how does retirement tax planning figure in? It's a very good question because the government still wants its share of those tax-deferred assets when you pass away. And like when you've seen how you set up things really matters, which leads us to the final key, number 4. Organize your assets for your family's benefit. Estate planning really matters. This is one of the most important ones, and you'll see why, of how you organize your assets will make a big determination on your family in the future. Okay, enough about death. Let's talk about long-term care. There's not a long-term care presentation, but about retirement and taxes. But believe it or not, there's a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state level. And on the other side, if you're receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement-style policies are tax-free. In addition, cash benefit-style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit of $390. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often the first inclination on the insured here is to tap the policy to pay for long-term care costs, but that's often at a tax mistake. Let's take a look at Florence, a widow woman who qualifies for long-term care benefits and lives at home in a home care. Her yearly care costs are $60,000. Florence's Social Security benefits is $20,000 annually, which covers her basic expenses, but not long-term care. She also has $400,000 in an IRA and a life insurance policy with long-term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long-term care costs. Any amounts used for long-term care will reduce the life insurance death benefit. Please note, this is just an example and is not meant to represent any specific policy, but many long-term care or life insurance hybrid policies work this way. First, let's suppose Florence is infirmed for 5 years and uses her policy to pay for long-term care expenses. That's why she bought it, right? Here, Florence pays little or no income tax during the period because she has such a large unreimbursed medical expense deductions. The $500,000 policy pays $300,000 or $60,000 per year for 5 years. That means her kids will inherit tax-free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in that IRA, which will be taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses the IRA money to pay for the long-term care expenses instead of the life insurance. Florence still pays for the minimal income tax per year because of her high medical expense deductions. And now the kids will inherit $500,000 of life insurance completely tax-free, as well as roughly $100,000 of remaining IRA money, which will be taxable. It's a much more efficient way to do it. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rate. But it's hard to imagine a scenario where paying her care with $300 of taxable money with minimal cost to Florence is no better option than paying for her care with $300,000 of tax-free money. In the second scenario, we are preserving the tax-free money for her heirs and paying the long-term care with Florence's taxable IRA money. Okay, we're towards the end and probably thinking, goodness, how in the world are we ever going to manage this? It's a good question. Let's bring it all together. And this brings us to our poll question number 3. What stage of retirement are you in? Pre-retirement, early retirement, middle retirement, or late retirement? I'll give you a few seconds to answer. Looks like we almost have everyone. All right, thank you. We started with a clear statement about the problems. Retirees often pay more taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So let's do a quick review on what we've learned in the context of our 4 stages of retirement. Under the pre-retirement heading, we saw the importance of understanding the after-tax value of retirement savings before you retire. And we also saw that in those pre-retirement years, it is critical to consider your tax-deferred savings and start taking advantage of funding Roth accounts and filling your brackets, something you do through your early retirement years and low tax years. We also looked at Social Security and taxes, plus the importance of couples have benefit strategy that considers a surviving spouse. And we saw Medicare and how its own tax-like structure that can push you off the IRMAA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go-go years. That's because starting in the middle retirement years, you'll be confronted with required minimum distributions, and we've seen the importance of planning your income needs before then and the tax issues involved. And then we see the importance of setting up your assets and managing them during your later retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All of those items together lead us to the obvious solution to our original problem. Because your tax exposure will change throughout your retirement, you need a strategy that anticipates how and when to tap assets to cover your personal expenses, understands the range of taxes you'll face in various stages, and manages the actions so you pay the lowest tax rates possible. By attending this presentation, you're indicating that you're preparing to leave the accumulation phase, saving for retirement, and moving into the distribution phase when you start spending retirement assets. We've seen the distribution phase as more complicated than working and collecting a paycheck. Managing the tax rate through your 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Naturally, we want to be efficient with our tax savings, and there are tax strategies to reduce your tax burden. But as with many things in life, This tax education and planning and advice, it's a lot to think about. Our tax code is complex and the rules keep changing. But what doesn't change is that you need a plan. And that's one more reason why I believe you should sign up for the Retirement Money Guide Tax Strategy meeting in the bottom left-hand corner. It'll give you a plan. It'll give you a roadmap for retirement and a way to spend down those assets in the most efficient way possible. I'll give you a second for those who are finishing. And remember, when you click on that meeting, it will take you to another page. As soon as you hit the X, it will bring you right back in. Now, I can see we've gone a little longer than I wanted to, and I'm sure there's a lot of questions. I've seen questions out there. What I'm going to do is I'm going to take everybody's questions. I'm going to put them down and answer them. I will send them anonymously to everyone who attended the workshop. That way you can get an idea of what other people were thinking besides your question. I want to thank you for attending, and I hope to meet with you soon and put together your custom tax retirement strategy that will benefit not only you, but your family as well. Thank you.